Options trading, and all trading really, is probability based. So if you don't understand statistics, then it's hard to really understand your trades. Sure, we can get lucky sometimes, but if we're not thinking in terms of averages, probabilities, and outcomes, then it's hard to really get a firm grasp on why we're making or losing money. And trust me, because I was there. If you think the math doesn't matter at all, then it's probably because you just don't know the right math yet. So in this video, I'm just going to break down 3 simple concepts that you're going to use everywhere in trading. And they're called the mean, the median, and the mode. So let's jump straight into it. All right, so the first concept is called the mean or the average. It's simple. When you're looking at a data set of numbers, you add up all the numbers and you divide them by the number of numbers that you have. For example, let's say we're looking at the numbers 4, 5, and 6. If we add all those up, we get the number 15. And since we had 3 numbers, we divide it by 3 and we get the number 5. So we can say that the average between the numbers 4, 5, and 6 is 5. In options trading, the mean number is often used when talking about our expected value. If we look at a history or a data set of all of our past trade returns, we could take the returns of all of our past trades, add it up, divide it by the number of trades that we placed, and we could say, on average, we are returning this amount or losing this amount per trade that we place, and that is on average our expected value of whatever strategy that we're running. Another quick example we could do is, what is the expected value of, let's say, rolling a 6-sided die? Well, we could say there's 6 sides, each has a number on it, 1, 2, 3, 4, 5, 6. Add all those up, divide it by 6, and we'll get the average expectancy of rolling a dice, which is 3.5. Now it's funny because you can't actually roll a 3.5 on a dice, right? It doesn't work. But over hundreds or thousands of rolls, that is actually the average number that you would get. And in trading, you really need to think the same way. We're not just playing for the outcome of one single trade. You're playing for the expected value across hundreds of trades. Now the second concept is called the median, or the middle number that is in our data set. And the median is really important when your data set has major outliers, or numbers that are significantly bigger or smaller than what we typically see in most of our data set. And that's because big numbers can significantly distort the mean. For example, let's say we had the numbers 1, 2, 3, 4, and 10 billion. In this data set, the median number would be 3. But the mean number would be something way higher because that 10 billion is significantly skewing things. The mean would be completely dominated by this 10 billion number and effectively render our calculation useless for figuring out what's normal. But the median would show us the real central point for this data set. And in trading, this really matters because once in a while, you'll have really crazy moves. Let's say a flash crash or something of that nature happens. And let's say you were trying to understand the typical daily move for a ticker, you would be a lot better off using the median in this case. The third concept is called the mode, which is the most frequently occurring number in the dataset. In trading, knowing the mode helps you understand what's the most common thing that happens, not just the average. For instance, if the most common return for a stock was 0.5%, that can be really valuable to know. It tells you what type of movement you should actually expect most often. So when setting up trades, especially these short volatility trades that we as option sellers are pretty much always using, understanding the mode can greatly align your expectations to reality. So this is why all this stuff matters in trading. The mean tells you your long-term expected value. It's how you build a winning strategy over time. The median gives you a clear picture of what a normal outcome can look like. It helps you cut through the noise and outliers. And then the mode tells you which result is the most common, which helps you set realistic daily or trade by trade expectations. Now, really, this is just the beginning. There's a lot of concepts that we're going to need to cover, and we'll do that all on this channel. So make sure to subscribe if you haven't done so yet. And you'll see in other videos, we'll dive much deeper into other concepts that are going to build on top of this. But if you don't want to wait and you just want to start trading strategies that actually work, click the link in the description of this video and take a free trial with Predicting Alpha. We have 5 systematic option selling strategies that have data to prove why they actually work, that have the data and the logic to back why they actually work. So come join the community, meet some really cool traders, and I'll see you there. So remember, mean, median, and mode. Understand these, use them in your trading, build better systems, run better strategies, and start thinking like a real trader.